Let me give you a realization that might change the way you see money forever. The people at the top don't usually get there by wages alone. Among America's ultra-wealthy, most fortunes come from ownership, starting businesses, holding equity, and controlling assets. In one analysis of the Forbes 400, most did not inherit the family business, and 69% had started their own business. That's the real difference between the 1% and everyone else. The 1% own things. They own businesses. They own assets. They own skills that are rare and highly paid. The other 99% are taught to do one thing: work, get paid, spend it, and repeat. Rich for a week on payday, stressed by the end of the month. And most people never get off it. But here's the good news. You do not need to be born rich to start thinking like someone who builds wealth. You need a system. And one of the simplest systems I know is the 25-15-50-10 rule. No matter what you earn, this gives your money a job. It stops the cycle of earning and leaking cash, and it helps you manage your money like someone building freedom, not just surviving another month. Step 1. 25% for growth. The first 25% of your income should go straight into growth. Not into random online shopping, not into stuff you won't even remember buying in 6 months. Into assets. Because poor people spend first and hope there's something left. Wealthy people invest first and let the rest adapt. If you're a beginner, start simple, start boring, start smart. That means low-cost index funds, something like an S&P 500 fund, because over the long run, broad market investing has historically compounded far better than cash sitting idle. Since 1957, the S&P 500 has returned about 10.56% annually on average before inflation, though returns vary a lot year to year and inflation lowers the real return. And don't just invest in markets, invest in your earning power too. Learning a high-income skill like copywriting, coding, sales, video editing, or marketing can raise your income faster than almost anything else early on. Then later, once you've built knowledge and cash flow, you can look at online businesses, digital assets, or higher-risk alternative investments. Now let me show you why starting early matters more than starting big. Billy invests $200 a month from age 20 to 60. Phil waits until 30, then invests $300 a month trying to catch up. Assuming roughly 10% annual growth, Billy ends up with about $1.26 million by age 60. Phil finishes with about $678,000. Billy wins by nearly $587,000, despite investing less each month, because compound growth rewards time more than intensity. That's the game. Not hype, not luck. Time. And if you want to protect that growth, use tax-advantaged accounts wherever you can, like an ISA, Roth IRA, or 401k. The IRS notes that qualified withdrawals from Roth accounts can be tax-free if the rules are met, including the 5-year rule and age, disability, or death conditions. Then automate it. Set the transfer on payday so the money moves before your brain has a chance to negotiate with itself. Step 2. 15% for stability. This is your stability fund. This is your safety net, your shock absorber, your life happened but I'm still okay money. The target here is 5 months of baseline expenses, your rent, groceries, utilities, transport, insurance, and the non-negotiables. Because one unexpected expense can wreck everything if you're not prepared. Picture this. You're 18, you finally get a bit of freedom, and you take out a loan to buy a VW Golf. 3 months later, the engine blows up. Suddenly, you've got repair costs, loan payments, stress, and no backup plan. One bad break, and your whole financial life starts wobbling. That's what happens when there is no safety net. And it's not just about inconvenience. The Consumer Financial Protection Bureau warns that financial shocks like car repairs, home repairs, medical bills, or loss of income can push people into debt or force them to drain other savings. Here are the rules for this money. It must be available within 24 hours. It must carry zero investment risk, and it should never be in the stock market. This is not opportunity money. This is protection money. A good place for it is a competitive high-yield savings account. Bankrate reports that many top accounts are paying around 4% APY, and the FDIC says savings deposits at insured banks are protected up to $250,000 per depositor, per ownership category, per bank. Build this before life forces you to, because without a safety net, one emergency can make you sell your investments at the worst moment. Step 3. Now for the biggest category, 50% for essentials. And this is where most people quietly destroy their future. The harsh truth is that a lot of people don't have an income problem, they have a lifestyle problem. Even on 6 figures, many people still live paycheck to paycheck. Bankrate found that 24% of workers earning $100,000 or more still say they're living paycheck to paycheck. Why? Because they're trying to look rich instead of becoming rich. So, let's redefine essentials. Essentials are not takeout 3 times a week. They are not subscriptions you forgot to cancel. They are not a gym membership you haven't used in 4 months. They are not convenience purchases disguised as self-care. Essentials are the things that keep your life functioning. And if you want to stay under 50%, attack the 2 biggest wealth killers first: housing and cars. That might mean renegotiating rent, getting a roommate, house hacking, living slightly below what people think you can afford. And when it comes to cars, stop financing your ego. A reliable used car will build your future faster than a brand new financed car that loses value the second you drive it off the lot. Then use this to stop impulse spending, the 7-day rule. If you want something, wait 7 days. If you still want it after a week, think again. If the feeling fades, it was never value, it was dopamine. And ask yourself one more question. Am I paying for actual usefulness, or am I paying for branding? A $60 pair of boots you use 120 times may be a better buy than $200 designer trainers you use 6 times trying to impress people who aren't paying your bills. That's how wealthy people think. Not can I afford the payment, but what is the real value per use? Step 4. 10% for rewards. The last 10% is the part most financial advice gets wrong. This is your joy jar, because if your money plan feels like punishment, you will quit. Extreme saving sounds noble on paper, but in real life, it burns people out. I've seen people grind so hard building income, businesses, and investments that their body eventually forced them to stop. That kind of stress catches up with you. The whole point of wealth is freedom, not building a prison with a higher balance. So, take 10% of your income and automate it into a separate account. A different bank account, a different bucket, a different purpose. And when you spend from it, spend it guilt-free. Use it for vacations, use it for hobbies, use it for nights out, use it for gifts. Use it for the things that keep you sane and remind you why you're working so hard in the first place. Because discipline without joy is unsustainable. And the people who win with money aren't the people who save the hardest for 3 months. They're the people who build a system they can actually follow for 20 years. Real wealth is not a garage full of cars. It's not designer gear. It's not proving something to strangers. Real wealth is waking up without panic. It's having options. It's being able to say no. It's taking care of the people you love. It's buying back your time. It's filling your life with experiences you'll remember long before nobody cares what logo was on your shoes. So, if you're tired of the paycheck to paycheck cycle, start using the 25-15-50-10 rule. 25 to grow, 15 to protect, 50 to live, 10 to enjoy. Do that consistently and you stop acting like a consumer and start moving like an owner. If you want more videos on building wealth, increasing your income, and escaping the financial treadmill, make sure you subscribe, because the sooner you learn this, the more time compound growth has to work for you.